Alright, everybody, so I guess I'm live now. Alright, I kind of want to just talk about mortgage a little bit. I've been doing a little bit of stock trading, and I'm saying I'm not wanting to invest in the real estate market. I'm going to explain why a little bit. I believe there's a huge housing bubble, and it's going to get really, really kind of ugly. And this is the reason why I'm thinking that. So, this is the mortgage crisis of 2008. Yeah, 2007. And it kind of talks about it down here. Anyway, we're not going to really drill down too much of the 2008 crisis, but draw some parallels of what's happening right now and what happened back then, because the 2008 mortgage crisis was, I think it's repeating. So we can see the housing market, the boom and the bust. We're just going to do it the housing market section first. So the boom and the bust. So I'm going to show you the boom, and I'm pretty sure we're at the beginning part of the bust, part because of the federal government, inflation, interest rates hikes, and all that. Speculations. So people are buying houses speculating that the value of their house is going to go up and it's going to be a great investment. High risk mortgage loans and lending practicing, borrowing practicing. There's some things going on that I think is extremely dangerous. We're not going to worry about the subprime lending, but that could be an issue. And then predatory lending. So let's pull up the boom and the bust. So, right around COVID, the housing market value went up very drastically, very, very quickly. And as you can see, it's starting to turn down. And I'll put all these links down in the description so you can take a look at it. But this is basically just kind of talking about, there's quite a few stories, and I think rental rates, especially if you're getting apartments, might be a little bit better. But that's where I think renting is really going to be ideal at this point versus buying a house. I'm going to go a little bit more detail with that later. I'm not going to close out. I'm just going to shrink it. So then we come down to the speculation side of things. So people are still thinking it's going to be going up, and you guys might be willing to take a little bit of a higher risk mortgage loan, and I'm going to explain why that could be very, very bad. So here prices are not plummeting everywhere, but prices to crash in Nashville by 20%, could plunge 20% next year. That's not counting the 20% that it has already crashed in Nashville. House buyers dropout is on the rise. So you could see pricing buyers out of the market. So your higher value housing there's not as many buyers for it. There's buyers that are backing out. And if you go drive, I know if I go driving around Dallas area in a lot of neighborhoods, there's a lot of for sale signs up. Even on the same street, there could be 3 or 4 signs. Houses are not selling. So the way you get a house to sell is to start lowering the price. With the interest rates being really high, you now have banks that are offering 0% home loans or low down payments, wrapping the closing costs and all of those costs in the price of the home. The reason why they're doing that is because they want to try to unload some of these properties. Sell at the top, not the bottom, right? So I'm going to go ahead and lower that. I'm not going to spend a whole lot of time on any one of these things because this video, I'm doing it live, so I can't really edit things out. But this video is already going to be a little bit long, and so I really kind of want to try to keep y'all's attention. So now we're going to talk about the high-risk mortgage loans and predatory lending. Mortgage fraud, unfortunately, that is kind of like what that is. So, I mean, there's only so much that we can do there. So, the average home in Texas is up. This is about 315,000. I took it down to about 300,000 in this thing, saying you did a low down payment. Maybe you covered your closing cost and you really didn't put a down payment, which is the house values is up 17.7% in a year, but that is misleading. So again, people might be, speculating the price. So let me actually put that back to 0. I did that there as a test to make sure that my calculations here were working. So home price of 300,000, interest rate at 4% of a $300,000 house would be about $1,432. This was medium-ish high, about a year ago. You could get a housing for under that. The federal government was really inflating or lowering the interest rates, which inflated the price of housing because it was easier, and so it created a huge demand for housing. The federal government now has it up about 7% if you have good credit. If you don't have good credit, getting 8 or even 9 or 10%, it's starting to happen. So that could have a difference of $770 if you bought the house some time ago versus today. That $770 is actually quite important. So let's say the housing market goes down 10%. So for every dollar, 10 cents. So that would mean your house is now valued at $270 versus the resale, if it went up 10%, would be $330. So this is kind of falls into the speculation and predatory lending. Because if you get locked in at this 8%, 9%, or you get an adjustable arm, they may tell you, oh, you could just refinance your house in a couple years from now when the interest rates are lower. I'm sorry, that's predatory lending because they're locking you in at this. I'm going to explain to you why that could be very, very predatory. So they're locking you in at a high interest rate. If you can't afford it, you can't afford it because what can happen 3 or 4 years from now can change drastically. I got a little bit of a calculator to kind of show you that. And this is also where mortgage fraud come in. I'll explain that a little bit here in just a second. That kind of all comes in on this next. Actually, we'll go ahead and do that screen now. So let's say, that $300,000 house, I basically worked the numbers to where it came in a little bit smaller to give you the wiggle room. And frankly, that's exactly what a lender is going to do to basically work the numbers to make it work. Mind you, they get paid when they get you into that house. So we have an interest rate of 7%, which is exactly what the government is offering right now. So we're going to leave it at the 7%, which is even slightly better than what we have it here. So we're just going to say you get it right at what the government is saying at the 7%. So 30-year term, and they say, oh, you could refinance the house, you could refinance the house, you could refinance the house in a couple years. Here's the reason why I say you can't do that. So here we say your monthly income is $7,000. You don't no, we're not adding any commissions or co-borrowers. That we're just saying everything is on that one. Okay. So you get the house, you can afford it. Everything's hunky dory. Your credit score is 680 to 690. And we're going to go to monthly liabilities. In this pre-calculation, you have a $400 car loan. We'll actually say it's $300, and you have an insurance payment $400. It comes out to basically in total $400. So in this scenario, you qualified for the house. But let's say in a couple years, after you've done some maintenance, maybe you bought some furniture, maybe you have a kid now, whatever, your expenses can go up. And I'm going to show you how little they need to go up before you can't afford this house at all. So say you trade in your car and you buy a car that's $200 more. Okay. So now that lowered the house value that you can mortgage at $288. Credit card, you bought some furniture, life happened, maybe a medical bill, maybe you bought a new computer, whatever you put on your credit card. So you have a monthly payment of, say, $500. You see how quickly that went down? So we went from $300,000 to what you could afford to $213. We're going to go ahead and roll that back. Let's say, because we're not done yet, $400 a month. I know people that have a credit card payment way above $400. Okay. But again, let's roll it back, say $300. So now we're back at $243. Installment loans, you had your house, AC broke. I just had to put an AC in my house about 2 years ago, a year ago. That is costing me about $200 a month because I did finance the repair. I had the money, but I chose to finance it. I got a super loan interest payment, so for me it made sense. Alimony, child support. We're going to use this in the terms of, oh, you have a kid now, right? So maybe you did get someone else pregnant and there's a kid outside of the house, but even if it's a kid inside the house, you're going to have costs related to that child. So we're going to put that cost at $200 a month. I don't know a single parent that's paying $200 a month on a child. It could be way more than that, especially if you have daycare, school, clothing, shoes, food, everything else. But I don't know, maybe you're working the lowest job you can, so we'll just move it down to $150. It costs, you have one kid, $150. We're not going to put any other loan, and you got internet at $50, your electric at $150, your water at, let's say, $50. So you're paying $200 in just your electric, your water, and internet. Your phone bill, you're just going to add $50. You're paying more than just $50. Now look at what you can afford. $153,000 house. Just because you can't afford it doesn't mean that you can refinance it 5 years down the road. We didn't add that much money to this equation. This is money that could be added to the equation in a course of 3 to 5 years. It could actually be a lot more. But in 3 to 5 years, trust me, you're not going to pay $150,000 on your house. You cannot refinance it. That was a huge part of the boom and bust speculation, that you could just sell the house for more money. You can't. If the housing went down 20%, that house is worth $360,000. If you bought the house a couple months ago, you've lost $40,000 in equity. You're paying $40,000 more for that house. You cannot sell it Oh wait, no, sorry, I was looking at the wrong one. It's $60,000 in the hole at 20%. You cannot get your money back. Okay, if the housing market goes down just 15%, that's $45,000. Let's say it goes down 25, $75,000. You can't afford that. You're going to go bankrupt. So, and this is where, you know, a little bit of mortgage fraud. You know, if you have a cost of a kid and you're not figuring that into your cost, well, we'll take that out. So that increases what you can afford. Say your car payment, you know, you want to buy that new car, but you're going to wait and you're going to drive your old one around, let's say it's 300, but once you buy that house, you're going to buy your new car in the same month or maybe a month after, which happens a lot because, you know, you don't want to drive up to your new house in an old car. People do this. So you increase your car payment in a year, you lower your other expenses, and you're lying on that document. You can get into a house that you can't afford. My father kind of did this a little bit, and trust me, he was not able to refinance. Now, my father was able to make, do the cover and all that. But you want to talk about stress? That was part of the 2008 housing crisis. And when you have housing that's sitting on the market, people were speculating that it would sell, they get the house, they turn around and they can sell it for $100,000 more than... That was fantastic a year ago. That's not the case anymore. The chances of you going upside down is very likely. And as prices start to slow down and the federal government is actively trying to make housing prices go down by increasing the interest payments, the finance costs, it's going to have prices drop. The people who can afford it, unfortunately, are making a lot more money. Don't buy a house that has you right on the edge. Honestly, my opinion is you're going to be better off buying a house later. Renting at this point might be better. And the great thing is if you're renting, if the dishwasher stops working, you don't have to worry about fixing it. That's $1,000. That's just for the dishwasher. If you know how to install it, which is not hard, you can do it yourself. But if you had to pay a plumber, it might cost you $1,500. A hot water heater can cost you almost $1,000 plus, not counting the installation of a plumber. A roof is over 10 grand. A garage door is like $1,500. Windows, so say you had an issue with the windows, that can cost you hundreds of dollars per window. And a lot of these things are not covered underneath a house insurance. Only if the house was vandalized or was storm damage. If the ground shifted and it caused damage to the windows, most times that's not covered by your insurance. They don't cover foundation. You could be whistling Dixie. Termites. So if you don't have, treatments going on to make sure that you don't have termites, that can literally cost you tens and twenties of thousands of dollars. If you're renting, it's not your problem. You get black mold. If you're renting, it's not your problem. You have black mold, that's going to cost not millions, but thousands of dollars to have someone come in and remove it, because that's not something you're just going to want to be like, oh, well, let me put on some gloves and clean it. owning a house is very expensive. I don't care if the mortgage payment is only $1,000. Renting, you're paying $1,200. That house will cost you more in the long run. If taxes went up an extra 2 or 3% on a $300,000 house, okay, so a $300,000 house, we're gonna say it only goes up 2%. That's an extra $6,000 a month that you will have to come up with. That comes out to $500 a month. The house I'm in now, which I do own, are payments. The taxes on it went up by a lot. Okay? Like, we're talking about thousands. It went up. If I didn't have the disposable income to be able to cover that, I would have to sell my house. If I put my house on the market and there's 10 other houses, I'm going to have to put my house at a lower price. Those 10 other people are going to see my house being sold for less. They can't afford to stay in that house. They're going to lower their price. At some point, people are going to start hitting foreclosure. Foreclosure prices are always lower than what that house could have sold for in other means. That's going to have a price crash. That's precisely what the government is trying to do, which is it needs to be done carefully, but that's how you start to fix inflation. If the house prices are inflated like they are right here, I mean, just from 2009 to 2020, from 2020 to 2001, you could just clearly see during COVID, when the government was paying out all this money, the interest rates dropped. It caused a massive price jump in housing. There's a bubble. Now, is a $300,000 house going to drop all the way back down to, at the $200,000 mark? I don't think so. I think we might see a price correction coming back to early 2001. Somewhere like, I don't know, somewhere in there. I don't know. But if you buy a house at $300,000 and then you owe so much money on it, you're not going to be able to refinance that house. You're going to be on the hook for the value of that house. If you have an adjustable arm on that house because some banker said, oh, you could just refinance, you're going to lose it. You're paying the bank money and you're maintaining that house for the bank. The bank knows that they were going to lose money on it to begin with. They're putting it on you, so you take the brunt of the hit while you're maintaining the house. And if you cause some damage to it, that's fine. They'll just fix it, and they're going to make money on you. Trust me. I'm going to wait until the housing market crashes. And I'll probably pick up 1 or 2 properties, and I'll rent them out. I'm not planning on holding them and selling them in a year for $100,000 because I am not going to speculate a high return on a quick resale. Be careful. Do a little bit of research. If you have some questions, post them down below. I might do a part 2 on this. There's so much information in here. Hopefully you guys were able to follow it. the housing market is going to be kind of shaky, I think. So honestly, renting, even if rent is really high right now, as the market crashes and investors are buying properties, either it be apartment or housing, they're going to have to put a renter in it. And as the prices come down, so should the rental rates. I wouldn't sign a 5-year rental rate. I would sign an agreement. I would sign maybe a 1-year rental agreement. Because I think in a year we're going to see the rental prices come way down drastically. Yeah, that's all I got to say. Not really a type of video that I've done a lot. Hopefully this was informative or kind of gives you some of my thoughts and reasons why I'm not going to be investing in the real estate market until after the correction, because I believe a correction is coming. So yeah, anyway, peace.